The Donchian Channels is a technical analysis tool developed by Richard Donchian. It is used to identify price breakouts and trends by creating a price channel based on the highest high and the lowest low over a specific period. Here's how it works and how it can be used in trading. The Donchian Channels consist of 3 lines. The upper band is the highest high over the selected period. The lower band is the lowest low over the selected period. The middle line is the average of the upper and lower bands. The typical period used for Donchian Channels is 20 days, but it can be adjusted based on the trader's preference. Donchian Channels help traders identify the direction of the trend. When the price is consistently touching the upper band, it suggests a bullish trend. When the price is consistently touching the lower band, it suggests a bearish trend. A breakout above the upper band can signal a potential buying opportunity, indicating that the price is breaking out to new highs. Conversely, a breakout below the lower band can signal a potential selling opportunity, indicating that the price is breaking out to new lows. If the price moves significantly away from the upper or lower bands and then reverses, it can signal a potential trend reversal. The width of the Donchian channels can indicate market volatility. Wider channels suggest higher volatility, while narrower channels suggest lower volatility. Traders often use Donchian channels to determine optimal entry and exit points. Entering a trade when the price breaks above the upper band or below the lower band can capture significant price moves. Imagine you're analyzing a stock that has been in a consolidation phase. If the stock breaks above the upper band with significant volume, it suggests strong buying interest and a potential continuation of the uptrend. Conversely, if the stock breaks below the lower band with significant volume, it suggests strong selling interest and a potential continuation of the downtrend.